on a complete hold for the entire fiscal, and I expect the commentary this time around to be more balanced. In fact, they will, as I said, enumerate the risks more clearly on the growth side, and especially the risks now which are coming from the global economy, and the fact that the weaker monsoon will also have a negative impact on growth, though not as much as it used to have. I think that's another point which they very clearly make, that agriculture in India is not as much rain-fed as it used to be, and that, I think, while on growth side would reduce the pressure on growth, but it will create pressure on inflation on the other side. So I am expecting the commentary to be more balanced. RBI would take into account the fact that risks to growth have gone up. At the same time, they will reiterate their concern on inflation, and I think they will continue to basically, kind of point towards the government taking complementary action in terms of creating space for the monetary policy to be eased during the fiscal year. So I do not think that they will not cut rates during the fiscal year. I think it's while the case for a rate cut has existed for quite some time, I think the timing is an issue, and I think the magnitude is an issue as well. So for instance, a 25 basis points rate cut will be neither here, neither there. So they will look to do a 50 basis points rate cut perhaps towards the second half of the fiscal.
Gaurav, what do you think the Reserve Bank of India can do to get growth back? Because yesterday they have also revised the GDP growth target from 7.2% to about 6.5%.
Well, first of all, actually, that's 6.5% is not the RBI target. It's actually a consensus survey of professional forecasters. So we'll only know RBI's target today. I think RBI's role in terms of pushing up growth is fairly limited, because this particular growth slowdown has been driven by a fairly sharp slowdown in investments, and investments in India are not necessarily a function of interest rates only. So the whole investment climate and for the reasons well known has deteriorated fairly sharply. And on top of that, the global economic environment, especially the global investor risk sentiment, and has especially the risk aversion has grown in leaps and bounds, especially over the last quarter, where the pressures in the Eurozone have again cropped up, and you see pressures around Spain now. So I think RBI from its own side has, in terms of growth, I think what they are trying to do is they are trying to actually ensure that growth remains sustainable over a longer period of time, for which they want to control inflation. They want to ensure that inflationary expectations are curbed, so that, because higher growth and higher inflation cannot coexist. So RBI is clearly taking a more medium-term, has a more medium-term view about what the monetary policy is supposed to do than purely short-term cyclical corrections. And I think, as they also pointed out, the monetary policy has definitely been eased, and I think some of the benefit of that you will start to see perhaps in the second quarter of this financial year. So I think from RBI's side, in terms of propping growth, their instruments available to them are fairly limited. So they will, as I said, at some stage during the fiscal year would look to cut interest rates. They already have injected, or they have been managing the liquidity in the system to ensure that there is liquidity shortages are taken care of. And I think at some stage they would perhaps look to switch from a liquidity deficit regime in the banking system to a slightly liquidity surplus regime, but that, I think, depends more on their comfort on inflation. So I think, in terms of what RBI can do in the coming, in the rest of the fiscal year, is basically at some stage, reduce rates as well as shift the banking system liquidity from deficit to surplus, and at the same time continue managing liquidity, so that the monetary transmission into effective rates becomes more effective than it has been so far, because of a deficit liquidity regime which has been operating for a while now.
All right, Gaurav, appreciate your time, and thank you for your insights 11 o'clock, the cat's going to be out of the bag, but like I've maintained that this time around Reserve Bank of India has done a great job of drumming expectations down. In the near term, it's not about what you deliver, it's about expectation management. So today if we get a rate cut, that will really spur the market. But if you don't get a rate cut, I don't think traders would pounce on the Nifty or they would go short on the bank Nifty, because bank stocks, especially PSU bank stocks, in the run up to the credit policy, most of the banking stocks are down by about 5 to 7%. Let's move on, and let me now bring on board Anil Singhvi, Chairman of Icon Investment Advisors. Anil, good morning. Great to have you back on ET Now. Anil, last time when we interacted with you on this forum, your closing comments were that India will go through a patch of weak economic growth and Indian markets will underperform in the near term. Whereas your call on economy has been bang on. Are you a bit surprised with the market resilience?
I'm actually quite surprised at the market resilience, because I expected markets to correct even more than what they've corrected, or what they've practically remain in the zone. They've not corrected. So I think the zone has been between 5,000 and 5,200 Nifty. So I'm a bit surprised on this kind of resilience, but maybe because the rupee has weakened to 56, so there may have been some opportunistic buying. But I don't think there is any fundamental case for Indian investment for a while. I don't think next 6 months to 12 months we can see there is a fundamental shift in a situation where people can feel very positive about Indian markets.
Anil, in the near term though, globally all eyes are on the ECB as well as the Fed. If there is indeed another round of quantitative easing, do you think that can bring about a bit of a flip up to our markets as well?
I think we've been all talking about quantitative easing and QE3, but I think at the end of the day that easing is not really going to help the cause of a country like India, which has really performed very pathetically. If you look at the other emerging markets, India has really done a very, very poor show, and our growth is now on a falling radar. So I think if we keep on falling onto the growth parameters, well, I mean, India people have been investing for growth, and if that story is not there, I really don't see people will be really jumping onto India, because risk aversion will still be there even despite having a large liquidity infusion on account of Q3, but still risk aversion remains. So I don't think India will be genuinely a good case for investments.
So then what explains $10 billion of fresh inflow in Indian equities this year?
Yeah, that's what I said, Nikun, that rupee's depreciation has really made to some extent an arbitrage opportunity, because rupee has depreciated, as you know, much more than most of the currencies. So that became a bit of a thing, and there was a hope. I think there was a little bit of hope that India may have a 6% plus kind of a growth. But I think looking at the current scenario, I will be really surprised if we can even touch a 6% growth. So I'm more pessimistic and negative than most other policy decision makers and the people who come often on your channel and talk about. I mean, I remember people talking about 7.5% just about 4 months back, and they seem to be just now going with the wind and talking about 6.5, 7. But I think even 6% growth will be a struggle with the kind of all, I don't want to be sounding very repetitive, but if you look at every parameter, I think we are falling, whether inflation, monsoon, investments, all that. So where the growth will come from? I mean, consumer spending can't hold us for a very long time. I don't think so.
Call you Anil the Bear, I'm not wrong, because every time you come on the show, you just scare me.
It's not by design, Nikun. It's not my doing, I can tell you that.
The true believers, however, are of the view, Anil, that markets at these levels are pricing in all the bad news.
Well, I wouldn't buy that argument, because when you look deep down into where our problems are, I mean, people live in hope, and I think we all should live in hope. So I don't find much of a fault in that. But beyond a point, living in hope alone doesn't work, because when Pranab Mukherjee was elected as the president, and there was a huge run up on this, that as if everything was his doing, and then things really started falling off because of Mr. Pranab Mukherjee. But I don't think that is the case, because finally it has to be a collective wisdom of the cabinet. Alone a finance minister can't do or can't achieve or can't fail. I mean, put it both ways on that. So my views remain same, that I think the ill today is a situation which we are caught into, that no one wants to take any decision. So if we remain in the same situation, we can't blame one Pranab Mukherjee or somebody else coming in his place for markets to really look very hopefully on that. For every situation, we have been dragging our feet. We can't do for a very long time. I mean, look at power failure yesterday. I mean, it comes in the Financial Times on an Asian edition on the front page. I don't think we should be known for it.